They say history repeats itself. But what if it doesn't repeat? What if it rhymes on a clock? Across centuries, empires have risen on the wings of credit, expanded on borrowed confidence, and collapsed under the weight of debts they could no longer outrun. Rome, Spain, Britain, each believed their system was different. Each discovered too late that debt, like gravity, always wins. But there's something deeper. Something buried in the ledgers of central banks and the archives of economic historians. A pattern. A rhythm. A cycle that stretches not across decades, but across lifetimes. Roughly 90 years. Long enough for one generation to forget the lessons of the last. Long enough for the same mistakes to feel like innovations. The last major debt cycle peaked in 1929. Collapse followed. Deflation. Depression. War. The global order reset. Then it began again. Slowly. Quietly. And now, nearly a century later, the clock is ticking once more. This is not prophecy. This is pattern. Let's rewind. The anatomy of a debt cycle. Before we look at 2026, we must understand what a debt cycle is. Debt is not inherently destructive. Empires, kingdoms, and modern states have always borrowed. The Roman Senate issued bonds. Medieval kings sold future tax revenue. The Dutch invented stock companies. Debt, when productive, builds roads, funds fleets, wins wars. It is the fuel of expansion. But debt has a life cycle. It begins small. Modest borrowing. High confidence. Lenders trust the borrower. Interest rates are reasonable. Growth follows. Infrastructure improves. Trade expands. Wealth accumulates. The cycle accelerates. Then comes the second phase, acceleration. Borrowing grows faster than income. Not because growth slows, but because debt works. It feels costless. A nation borrows to build a port. The port generates revenue. More borrowing follows. Investors compete to lend. Interest rates fall. Debt compounds. The third phase is saturation. Debt now grows faster than the economy itself. The borrowed money no longer builds new capacity, it services old obligations. The empire borrows not to invest, but to survive. The currency weakens. Inflation creeps in. Lenders grow nervous. The fourth phase is the trap. Debt becomes unpayable. Not because of collapse, but because of mathematics. The empire cannot grow fast enough to service what it owes. Default looms. Or inflation. Or both. This is the velocity trap, and it closes every 90 years. 2. The 1929 peak, the last great reversal. The Roaring Twenties felt unstoppable. America had emerged from World War I as a creditor nation. Europe owed it billions. Stock markets soared. Credit was abundant. Margin debt exploded. Everyone believed the new era had abolished the old rules. But beneath the surface, the velocity trap was closing. Corporate debt had tripled since 1920. Consumer credit had surged. Banks lent recklessly, convinced that growth would never slow. The system was over-leveraged, not visibly broken, but mathematically doomed. Then came October 1929. The stock market crashed. But the crash was not the cause. It was the symptom. The debt cycle had peaked. Credit contracted. Deflation took hold. Banks failed. Businesses collapsed. Unemployment soared to 25%. The global economy shrank by nearly a third. Governments tried everything. They cut spending. They raised tariffs. They clung to the gold standard. None of it worked. Because the problem was not policy. It was the cycle itself. The debt had compounded for 30 years. It had reached escape velocity. The only way out was destruction. By 1933, the United States abandoned gold. By 1939, the world was at war. The debt was erased. Not by repayment, but by reset. War, inflation, and default wiped the slate clean. The cycle ended, and a new one began. 3. The slow rebuild, 1945 to 1980. The post-war world was rebuilt on the ashes of the old debt. The Bretton Woods system anchored global currencies to the dollar, and the dollar to gold. Debt levels were low, savings rates were high, governments invested in infrastructure, education, and industry. Growth was real, not borrowed. For 3 decades, the system worked. Debt grew, but so did income. Leverage remained manageable. Central banks were cautious. Fiscal discipline was the norm. The memory of the 1930s was still fresh. No one wanted to repeat the mistakes. But by the 1970s, cracks appeared. The United States had borrowed heavily to fund the Vietnam War and Great Society programs. Gold reserves dwindled. In 1971, President Nixon severed the dollar's link to gold. The anchor was gone. The fiat era began. Inflation exploded. Oil shocks followed. Stagflation gripped the West. The debt cycle entered a new phase, no longer constrained by gold, but only by confidence. Central banks raised interest rates to 20% to break inflation's back. The cost was brutal. Recessions followed. But the cycle was reset once more. By the early 1980s, debt levels had stabilized. Real interest rates were high. Inflation was crushed. The stage was set for the next great expansion. And the next great trap. 4. The acceleration, 1980 to 2008. From 1980 onward, debt grew faster than at any point in modern history. Not just government debt, but household debt, corporate debt, financial sector debt. Credit became the engine of growth. Interest rates fell steadily for 30 years. Asset prices soared. Real estate, stocks, bonds. Financial innovation exploded. Securitization, derivatives, credit default swaps. Debt was repackaged, sliced, and sold as safe. Leverage ratios in the banking system reached historic highs. Shadow banking grew larger than traditional banking. Risk was hidden, not eliminated. By 2007, total global debt had reached 300% of GDP. In the United States, household debt peaked at 100% of income. Subprime mortgages were bundled into AAA-rated securities. The system was over-leveraged. Again, not visibly broken, but mathematically doomed. Then came 2008. Lehman Brothers collapsed. Credit markets froze. Banks failed. Governments bailed out the system with trillions. Central banks slashed rates to zero. Quantitative easing began. The cycle did not reset. It was paused. Debt was not erased. It was transferred. From private balance sheets to public ones. From banks to central banks. The trap did not close. It widened. And the clock kept ticking. 5. The final phase, 2008 to 2026. Since 2008, the global economy has survived on life support. Interest rates have remained near zero for over a decade. Central banks have printed over $25 trillion. Governments have borrowed without consequence. Debt to GDP ratios have exploded. Japan exceeds 250%. The United States exceeds 130%. China's total debt exceeds 300%. This is the saturation phase. Debt grows faster than income, not because of crisis, but because of policy. Governments borrow to fund deficits. Corporations borrow to buy back stock. Households borrow to maintain consumption. The system cannot stop borrowing without collapsing. And now, velocity is slowing. The speed at which money circulates through the economy has fallen to historic lows. Each dollar of new debt generates less growth. The marginal productivity of debt is collapsing. This is the velocity trap in action. By 2026, roughly 90 years will have passed since the last Great Reset. Not because of mysticism, but because of mathematics. Debt compounds. Velocity slows. The system reaches a point where it cannot grow fast enough to service its obligations. Something must give. History suggests 3 outcomes: inflation, default, or restructuring. Each has happened before. Each will happen again. 6. Echoes across empires. This cycle is not unique to modernity. Rome debased its currency for centuries before collapse. Spain defaulted 7 times between 1500 and 1650. Britain surrendered its reserve currency status after World War II. Each believed their system was different. Each discovered the same mathematical limits. The 90-year rhythm is not supernatural. It is generational. Long enough for institutional memory to fade. Long enough for policymakers to believe this time is different. Long enough for leverage to rebuild to dangerous levels. The players change. The technology evolves. But the pattern persists. Debt expands. Growth slows. Confidence cracks. The cycle resets. We are not watching the end of the world. We are watching the end of a debt cycle. It has happened before. It will happen again. 7. The cycle repeats. Empires rise on confidence. They fall on arithmetic. The 90-year cycle is a reminder that economies, like ecosystems, cannot grow forever without correction. Debt is not evil. But unchecked, it becomes a trap. 2026 may not be the exact year. Cycles are not precise. But the pattern is undeniable. Global debt has reached levels never seen in peacetime. Central banks have exhausted their tools. Governments have borrowed without limit. The velocity trap is closing. Understanding this is not about prediction. It is about preparation. Not through panic, but through pattern recognition. History does not repeat. But it rhymes. And the rhythm is getting louder. The cycle is ancient. The players are new. The lesson remains the same. This channel explores the economic forces behind empires, currencies, and power. Not to predict the future, but to understand the patterns that shape it. The velocity trap is not a conspiracy. It is a cycle. And the clock is ticking.